Hey everyone, welcome to Chapter 5, Interest Rate Theory. Let's take a look at our objectives here. So first we'll discuss how banks are quoting interest rates and how we compute an effective annual rate, or ERA. Then we'll take a look at TVM equations and just simply discuss how we change or modify these equations to adjust for the compounding periods per year. We'll look at an amortization schedule, and we can hopefully see the payment changes as the compounding or annuity period changes. And we'll talk about real rate of interest and how it's adjusted to account for the impact of inflation on nominal rates. Also, the default premium and the maturity premium, how that adjusts our interest rates as well. And last, we'll just take a look at a couple yield curves and discuss their implications. So first, the annual percent rate, which is the most commonly quoted interest rate, is usually used for most loans and fixed income statements. However, unless interest is charged only once per year, so unless it's charged annually, APR will understate the true cost of interest to the borrower. Very often, lenders charge interest more often than once a year. So for instance, in this case, we're charging monthly. So we need to adjust this annual percent rate because this is annual. So we need to understand that M in this case is the number of periods compounded per year. So if it's monthly, it's going to be 12 periods. So we take that annual rate divided by 12, and we get a monthly periodic rate in this case of 1%. Now, an increase in frequency of compounding leads to a reduction in the periodic interest rate. So you can see here, it's dropped down to 1%. But there's an increase to the effective annual rate. Okay, so because the interest earned on each period is also earning interest for the subsequent period. So the ERA is actually what we're truly earning. Okay, so it's the true rate of return to the lender and the true cost of borrowing to the borrower. Okay. So sometimes ERA is also known as annual percent yield. That would be if you're actually investing. So what is your true yield versus the effective annual rate if you were borrowing? What is your true cost? Okay. Either way, we can calculate that. Once we get our periodic annual percent rate, we can plug it in, and we can easily solve for ERA. Now here's just an example of how we convert that annual percent rate to our periodic rate. Okay, so again, in that example, we had monthly payments, so we would divide the APR by 12 to give us our periodic rate. But you can see if it's quarterly, we divide by 4. If it's daily, that means there's 365 times that it's being charged interest. We have to adjust for that as well. Now, another thing to consider in terms of interest rates is the difference between real and nominal. Okay, so the real interest rate, again, is what will be provided, but we have to understand there's more dimensions to interest rates. So one thing we need to take into consideration is inflation. So as you can see on this axis here, we move from real to nominal when we add H in this case, which is considered inflation. So an example of the nominal rate for a treasury bill added with inflation is considered the risk-free rate, therefore the RF. Now the reason why a treasury bill, or perhaps if you get a GIC or certified deposit, some sort of investment in a bank or the government, the reason why it's considered risk-free is because typically speaking, the risk associated with getting your money back is quite low. Okay, so again, remember, a treasury bill is you as a lender just lending money to the government, and as long as we know the government will pay it back, there's no risk associated. Now, if we take a look at this axis here, okay, so we go from risk-free to more risk, then we have to add on a premium. So this is a default premium, right? So when we mean default, we mean that the likelihood that the borrower won't be able to pay back the loan. Okay, so they'll default on their loan, So we have to account for that risk. So, perhaps you're investing in a stock or something like that. There will be some sort of default risk associated with that. So those are some more dimensions when we're trying to determine interest rates. Now let's consider the effect of compounding periods on TVM equations. So as you remember, TVM equations, you need to have your periodic interest rate and your number of periods. But what's really important is, since now we're changing the periods, we're not doing annual payments like we've done in the past, we have to make sure that our frequency is consistent when we're entering it in. And we'll take a look at that in a little more detail with Excel. But just a reminder that the interest rate and the number of payments have to be adjusted based off of the time of compounding periods. And the more often that we make payments, basically the lower total amount that we're going to pay. And why is that? Well, because more money goes into the principal and less interest is charged. So let's take a look at an example here. So in this case, Jim, he can borrow $50,000 from a business, and the bank agrees him to lend him the money. So he's going to have it lent over a 5-year term with an APR of 9%, and he has the option to pay it annually, quarterly, or monthly payments with no charge in quoted APR. So what we're going to do is we're going to compare the annual, quarterly, and monthly payments and see which one is best, which one is more expensive, or which one costs less. So again, we have our known variables here, and don't worry too much about the numbers. This is how we do it in the calculator. We'll discuss it more in Excel. But one thing I do want to point out is if you take a look at the number of periods. Okay, so again, we're used to paying annually. So the number of periods, of course, if it's 5 years, it's usually a 5-period term, which makes sense for annual payments. Okay, but if you take a look at quarterly payments, you'll notice the number of years have changed. Okay, because it's no longer the number of years. It's the number of periods or payments. Okay, so even though it's 5 years, we're going to multiply that by 4 because we're paying quarterly, so we're paying every 4 times a year. So we multiply by 5 to get the 20. And again, if we take a look at monthly payments, we're now seeing 12 payments in a year. So 12 times 5 is going to give us 60. But again, don't worry too much. We'll discuss more about that. I just wanted a little reminder when you work on your Excel sheets. But what's important about this is take a look at the total payments. So annually, we're paying $12,854. But if you take a look at the payments made quarterly, or the total quarterly payment, okay, is $12,528. So it's a little bit less. And finally, our total annual payment, if we pay monthly, is $12,455.04. So you can see the more payments that we make, it basically means the less money we have to pay for that overall loan. Now moving on to amortization schedules. Okay, and if you recall from our previous chapter, when we charge the interest, it's only on the outstanding loan, or the outstanding balance of the loan. So the more frequency and size of the payments means less interest being charged, which means we can pay off our principal quicker and we can pay our loan quicker. So let's just take a look at a schedule here, just again as a reminder. And we can see here, reminder, so again, we're only paying interest on our outstanding loan. And you can see, in this case, we have a 72-month amortization, so it's 6 years being paid monthly. Okay, so in other words, 72 payments are going to be made in that 6 years. Okay, and you can see that each time our ending balance goes to our beginning balance, we're paying less in interest because we're paying less on that beginning principal. And what's also we see is that eventually, when we move towards the end of the loan, we're paying very little interest, and the majority of our payments are comprised of principal. Now this is the minimum payment of the loan, okay, but any additional payments can be made, and they'll be applied to the principal balance, and thereby reducing the outstanding balance and resulting interest charge over the next period.